Establish offshore trusts in jurisdictions with tax benefits. This can help you maximize your financial strategy. Invest in global opportunities that allow you to capitalize on favorable tax policies of foreign countries. Ensure offshore accounts are set up per legal guidelines to avoid penalties. Wealthy individuals often use tax loss harvesting to offset capital gains taxes by selling underperforming investments. Identify underperforming investments in your portfolio. Sell these assets to realize losses and offset gains. One well-known strategy is donating to charity. Charitable donations can provide significant tax deductions. To benefit from tax deductions, contribute to qualified charitable organizations. Consider setting up a donor-advised fund. Investing in private equity or hedge funds allows for tax-advantaged structures. These funds often minimize tax exposure. Consider investing in private equity funds to take advantage of these tax strategies while being aware of high fees. Health savings accounts provide triple tax benefits. Contributions are deductible, money grows tax-free, and qualified withdrawals are also tax-free. Contribute to an HSA if you have a high deductible plan. Use it to cover qualified medical expenses. High net worth individuals often use income splitting strategies to reduce their family's tax burden. Transfer assets to lower tax bracket family members to lower your overall tax bill while maintaining control.
15 legal ways the wealthy use to minimize their taxes. The world of taxation can seem like a maze, but for the wealthy, it's often more like a game of strategy. While most people see taxes as something they must pay without question, the wealthy have figured out how to minimize their tax burdens using various legal and financial strategies. In this video, we will explore 15 ways that the rich use to legally reduce their taxes. Some of these methods may surprise you. 1. Capital gains tax advantages. The rich often earn a significant portion of their income through capital gains, which is the profit from selling investments such as stocks, bonds, or real estate. One of the most significant advantages of capital gains is that it is taxed at a lower rate than ordinary income. For instance, in the United States, long-term capital gains, from investments held for more than a year, are taxed at a much lower rate than regular income. By strategically investing in assets and holding them long enough to qualify for long-term capital gains, wealthy individuals pay significantly less tax on their profits.
Be aware of the gift tax limits and the annual exclusion to avoid additional taxes. Wealthy individuals use depreciation to offset income taxes, allowing property owners to write off the cost of an asset over time. Depreciate assets that have a long useful life, understand the depreciation schedule, and consult a tax professional. Business owners can reduce taxable income by deducting a wide range of business expenses. Deduct legitimate business expenses from taxable income and keep meticulous records. One of the most tax-efficient investments is municipal bonds, which offer tax-free income. Invest in municipal bonds from your state to take advantage of tax-free income. Trust funds minimize estate taxes. By placing assets in a trust, owners can retain control over distribution. Set up a trust to transfer assets and consult an estate planner to ensure wishes are followed. A 1031 exchange allows deferring capital gains taxes on an investment property when another similar property is purchased. Use proceeds from one property to buy another and ensure qualifications are met for the exchange. Establishing residency in low-tax jurisdictions helps minimize taxes significantly. Follow all legal requirements for residency and consider both personal and corporate taxes
And maintenance costs. Additionally, the depreciation of property over time can be used as a tax write-off. Many wealthy individuals and corporations use real estate investments to significantly reduce their tax liability through these deductions and other tax strategies. How to use this strategy? Invest in rental properties to deduct property-related expenses. Depreciate your property over its useful life for tax deductions. Consult with a tax professional to fully understand the real estate tax breaks available. 4th, offshore accounts and trusts. Many rich people use offshore accounts and trusts in low-tax jurisdictions to legally shelter their assets. By setting up trusts or accounts in countries with favorable tax laws, wealthy individuals can avoid paying taxes on certain income or assets. These tax havens, which include places like the Cayman Islands, Switzerland, and Luxembourg, offer low or no taxes on income and capital gains. While offshore accounts are legal, they can sometimes be controversial. However, when used correctly, they offer a legitimate way to reduce one's overall tax burden. How to use this strategy: establish offshore trusts in jurisdictions with tax benefits. Invest in global opportunities that allow you to capitalize on the favorable tax policies of foreign countries. Ensure that offshore accounts are set up according to legal guidelines to avoid potential penalties. 5. Tax loss harvesting. Wealthy individuals often use a strategy called tax loss harvesting to offset capital gains taxes. This involves selling investments that have decreased in value, i.e., realized losses, and using these losses to offset gains made elsewhere. By doing this, they can reduce their taxable income and lower their tax liability for the year. This strategy is particularly useful in volatile markets, where stocks and other assets may fluctuate in value. How to use this strategy: identify underperforming investments in your portfolio. Sell these assets to realize losses and offset gains in your portfolio. Be aware of the wash sale rule, which disallows claiming a loss if you buy the same or similar security within 30 days. 6. Charitable donations and deductions. One of the most well-known tax strategies is donating to charity. The wealthy often contribute to charitable organizations to receive tax deductions. Charitable donations are tax deductible, meaning they reduce your taxable income for the year, which can lead to significant savings. Billionaires like Bill Gates and Warren Buffett have made headlines for their philanthropic efforts, but their charitable donations also help them reduce their tax liabilities. How to use this strategy: contribute to qualified charitable organizations to get tax deductions. Consider setting up a donor-advised fund, DAF, for charitable giving. Keep track of your donations and ensure they meet tax deduction requirements. 7. Private equity and hedge funds. Investing in private equity or hedge funds allows wealthy individuals to take advantage of tax-advantaged structures. These funds typically use legal methods to minimize taxes, including capital gains treatment on profits, tax deferrals, and the ability to write off certain losses. Private equity funds are usually reserved for wealthy investors, but they offer a unique opportunity to structure investments in a way that minimizes tax exposure.